Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. All right, so let's get started. Thank you once again for everyone for joining in on our Tuesday session on real estate and taxes. Today is, Christmas season, holiday season. So I'm wearing my Christmas gear and I'm gonna keep today's topic very light and something that we can brush through very quick, because I know everyone is probably taking some time off to spend it with their family, and I don't want to keep you guys here for too long. So without further ado, let's get started. My name is Lakshay. Today's topic is 12 tax saving tips, Christmas edition. As you can see, I'm also wearing a Christmas sweater. Hope everyone is also in the mood for holidays and enjoying some time with their family. So let's get started. If you want to save some taxes this year, there are a few strategies that I've compiled. As it's the year end, I've compiled something that is called 12 tax strategies for small business owners. This can include paying yourself bonuses. Paying yourself bonuses from or a salary from your business would basically mean reducing your business tax returns. So basically, if you have $100,000 of income in your business and you pay yourself a salary of $25,000, that $25,000 is technically an expense to your business, and it can reduce your business's tax return, business's tax payable. So that can really help you reduce your taxes. And if you haven't done, or as a shareholder, if you haven't taken any salary, this is a great way to reduce your taxes. Number 2 is deducting home office expenses. I'm working from home right now, but I'm sure you were also using your home at some point of time throughout the year. If you are using your home, you can to reduce your taxable income. What are some of the examples? Well, it includes telephone bill, internet, home insurance, hydro, part of your rent or mortgage, school and municipal taxes, and basically home maintenance. This can certainly help you reduce some of the tax liability that you may have in your 2022 or 2023 tax return. Let's move on to number 3. It's the year end. It is the basic. You must have been hearing ads about RRSPs, RESPs, TFSA. Each of them have their own contribution limit. RESPs does not allow you to reduce your taxes, but RRSP, TFSAs, and FHSA, which is a new one, can technically help you reduce your tax liability. How does it work? So let's assume you're making $140,000 in 2023 and you put $15,000 in your RRSP. This would technically mean now you're not paying taxes on the $140,000 of income. You're gonna be paying $140 minus 15, which is $125,000 of income. So this helps you reduce your tax liability by $15,000. I would highly recommend look into your notice of assessment from prior year to help you reduce your taxes for current year, because this can certainly be the answer to a lot of the easier tax strategies to implement. You can simply just go to the bank, call them, book an appointment and start contributing to your RRSP. This can give you a very good difference when it comes to your personal taxes. Now you must be wondering, should I be going for TFSA or RRSP? Well, I would recommend maxing out both of them, but if you had to choose between the two and you don't have enough funds to max out both of them, because RRSP has a contribution limit of 18% of prior year and TFSA has a contribution limit of $6,500. $6,500 plus the 18% of RRSP might be too much of savings. You might not have that parked away right away. So what I would say is basically look at which income criteria you fall under. If you're earning less than $50,000, I would recommend first start off with your TFSA and then move on to your RRSP contribution, because in $50,000 your tax bracket is already the lowest, so contributing to your RRSP doesn't give you the maximum impact. Let's assume you're earning more than $98,000. If you're earning like over $100,000, then in this case your tax rate is roughly in the higher range, which is 40%. So investing in the RRSP is a better option for you. And if you are in between 50 and 98, then you would want to max out both of them. So So higher income requires RRSP contributions. Under 50,000, make use of TFSA. But if you're in the range of 50 to 98, then focus on maxing out both of them. But yes, TFSA, feel like always look at TFSA as the first thing you want to max out or use, and then move on to RRSP. Next, I would want you guys to start organizing yourself. Whether it be any sort of expense related to vehicle, you would want to keep a very good track record. We already have, some audits that we have dealt with in the past where people might think that, hey, I'm going to provide credit card statements because that has all the, gas receipts or all the things that they might have paid through, and that will be a sufficient package. The answer is no. What you should be doing is you should create an email called maybe lakshay.invoices@gmail.com and start taking pictures of that, and then keep it for your reference. When you have it sent to your email address, and if there was ever an audit 2 years, 3 years down the road, you can simply just go to the email, and with the timestamp, you will have all the receipts saved there. So it is very important, whether it be small receipts like fuel or meals and entertainment or license and registration, all of these expenses related to vehicle, you want to keep a mileage log, as well as you want to keep a good track record in order, if there was an audit, they're gonna look at the actual receipts. Bank statements are not qualified to be used as a proof for your tax audit. Next is, if you have a lot of business going on, you usually, whenever someone incorporates, they open a business bank account. What they forget to do is this: continue to use their personal credit card for business expenses, and at the end of the year, everything gets mixed up. So what we want to suggest to you is basically have a business credit card to keep track of all the business expenses, so nothing gets mixed up at the end of the year. So even in some of the times you have receipts that you can't keep track of, or if there's some notes at the back of the receipt, that will also help you identify, hey, that I gave a gift card for so and so for the referral, I gave a wine bottle on so and so's closing at the end of the year. So these are some of the things you want to make note of at the back of the receipt, and back up your receipts in order to store them in a digital format, because receipts lose their color after a couple of years. So again, business credit card, business account, make sure to use that in order to keep track of all of your income and expenses in separately. Next is, if you have more than $3,000 of tax liability last year, possibility is you're gonna have more than $3,000 of tax liability to this year as well. So what I would recommend is start paying installments. If you don't pay installments to CRA, which is called advance installments, so let's say for 2023, if you're self-employed and you're making money and your tax liability is over 3,000, you should technically have paid 4 installments to CRA in March, June, September, and December. This will technically help you, minimize the tax liability at the end and avoid interest. So if you don't make these installments, CRA will charge you interest at the end of the year on the total tax bill. So avoid that. Start paying installments if you know you have more than $3,000 of tax liability this year. Some of the tax deductions that you want to consider is, these are all cookie cutter. They're applicable to most of the businesses. It could include accounting fees, business advertising and promotional expenses, business taxes, licenses, membership. This could be RICO, professional liability insurance, TREP, any charitable donations you may have made from your business, meals and entertainment with your clients in restaurants, or through a customer success party. All of this is up for game. Even tools and equipment that you may have purchased in order to be a successful, whether it be a realtor or any sort of other business that you're using this for. So keep track of all of them, and this would be a good time to start organizing those expenses. Next is something that is a little bit controversial. Delay collecting income to next year. What do I mean by this? So for example, if you had transactions that are closing in maybe December and the check hasn't hit the bank account yet for you, you can ask your brokerage to kind of delay the check to next year in January. This way the income for Jan to December would not change, and the new cycle. It will hit in 2024, so the income will be considered for 2024, and that allows you the entire year of 2022 to pay the taxes for that. So let's assume I have a $10,000 coming in on 27th of December. I would request the brokerage to maybe pay it in first week of January. Reason being, from Jan to 2023, my tax year is almost complete, and I have already recorded all of the income that was needed for 2023. Any income that I add anymore is gonna either push me in the next tax bracket, or it's just gonna increase my tax liability with the income and the HST. So why don't I just push it to the following year, which is 2024, and now the HST as well as the income will be counted in 2024 rather than in the current 2023 period. This can technically help you reduce your HST as well as your tax bill for 2023. Again, a little bit controversial, but whatever helps, I'm willing to. So let's assume you have a spouse who's a housewife, and you are a high net worth, high income producing individual. If you're making $200,000 and then you invest in something and make more money, the investment income will get taxed at a very high tax rate, right? Agreed. If you lend it to your wife and the wife invests the money in some sort of a real estate or anything outside, any income that she will earn, she is not a high tax individual. So what she can do is she can record the income on her taxes. This will split income. Basically, you're transferring your income that was supposed to be coming to you for investment and moving it to your wife. And this way you can technically reduce your tax liability and make use of her lower tax bracket. So there are some rules to lending money to your spouse. You must be charging interest to her, and the interest payment must be minimum 5% prescribed by the CRA, and you must make sure that she pays you interest on the money borrowed by the 30th of the following year. So for 2023, if my spouse borrowed $100,000 from me, the interest would be $5,000. That $5,000 interest must be paid by my spouse to me by the January 30th, 2024. So that will certainly, help you move your high tax income from you to your spouse who's in a lower tax bracket, and which is why we're lending money to her and, just earning interest of 5% rather than investing in $100,000 and you'll making maybe $25,000 on top of it. That last $25,000 will get taxed at 50%. Move it to your spouse. She'll pay lower taxes because she doesn't have much income. Next is buying assets at the end of the year. I personally gifted my dad a car from my corporation, and I'm using that as an example that I want to share with you. If you are using your vehicle for business purposes, you can write off that expense from your business. Although the business just purchased the asset, which is technically 2023 at the end of the year, you can still write off the entire cost in 1 year. Let me rephrase this. Usually when you buy any asset that you buy from outside, you have to write it off against your business income year by year. If you buy a zero emission vehicle, you can write off the entire cost up until $59,000 in 1 year, provided that the vehicle was used for business. So my dad uses, we're in the smoking accessory business. He has delivery vans. So, we gifted him a delivery van, which is zero emission vehicle. This will allow him to write off his taxes his taxes can significantly go lower because we were able to use that $59,000 deduction. So make use of it, buy assets because they allow you to reduce your taxable income significantly. You can depreciate it year over year. If it's not a zero emission vehicle, you can still buy it in December and you can write it off for the entire 2023. So if you made $100,000, $50,000 vehicle was purchased, that $50,000 vehicle cannot be written off if it's not zero emission, you cannot write it off in 1 year. So you would maybe write it off in the next 5 years, $10,000 each. But if it's zero emission vehicle, you write off the entire $50,000 in 1 year provided it's used for business. So buy assets, reduce your taxable income. Even if it's December, you get to write it off for the entire year of 2023. Next is client gifts. It is the gifting season, it is the holiday season. So I wanted to mention that whenever you're giving a gift, it's always a good idea on the back of the receipt, write what property address this is for. So if you've done 10 closings in current year and you're giving to all 10 people a small token of appreciation or happy holidays or a gift set, you're not going to remember this from 2 years from now who this closing is for, who this gift was for. So I highly recommend on the back of the receipt, write down the property address that if you're a realtor, whoever you're giving this to. So this way, if there was ever an audit, you can kind of correlate it to agent earnings report that there were 10 closings. This gift was provided to this client for this property address, and CRA will appreciate that, okay, it matches. Otherwise, if you don't have proper documentation, it is denied. So client gifts are easily a category that can help you reduce your taxes, provided you have all the appropriate documentation, supporting docs, and that are kept in a very nice manner that can be presented to CRA. And that kind of wraps up today's presentation on 12 tax saving strategies. I hope you enjoyed it. All right. Thank you once again for joining in. Really appreciate everyone's timing. I hope a very happy and safe holidays to every one of you guys. Hope to see you in the new year. This is going to be the last session for year 2023. I'll see you in 2024 every Tuesday with a brand new topic on real estate and taxes. Thank you very much. Have a great day and stay safe. Thank you.